One of the more interesting earnings reports last week came from Ford, and this actually followed earnings from General Motors, which were really positive. They raised guidance for the year. Ford came out and the stock got absolutely pummeled because results didn't meet expectations. And there were actually some interesting warning signs from Ford specifically. Now, the question is this something that's going to be prevalent across the industry, particularly on the ICE side of auto manufacturing? Because we knew that there was going to be weakness in electric vehicles. Ford continues to lose a ton of money on its electric vehicles, but that's kind of the case across the board for everybody but Tesla, and their margins are just still coming down. So just a very, very competitive space, a tough space to be in. But these companies are making very different decisions as well. General Motors has decided to pull back a lot on its electric vehicles, going to launch a few more later this year. That business is starting to scale, but they've really pulled back on saying, hey, everything is going to be electric by 2035, or we're going to sell 1 million vehicles. I believe it was by the end of next year. Meanwhile, Ford is pushing forward, making vehicles that, frankly, nobody really wants. And so it's kind of a strange situation for Ford. In some ways, the numbers looked really good. The core business was actually pretty strong, but the electric vehicle business was very weak. And there was something that investors really latched onto. That is the warranty expenses that Ford is incurring right now. One of the challenges with being an auto manufacturer is you have warranty expenses and you put money aside for that every single year. But if those expenses end up being higher than you expected, you end up having quarters like we saw from Ford. So I want to dig into some of the numbers and what it might mean across the auto landscape. Because Ford is not a stock that I own, but I do own GM and I watch the EV landscape very closely. So that's the lens with which I'm looking through these results. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get to some of the more interesting pieces of the results. To start, I want to just highlight some of the things that Ford highlighted early in their release. You can see that revenue, $47.8 billion, net income, $1.8 billion, adjusted EBIT, which is a metric that a lot of these automakers use, earnings before interest and taxes, $2.8 billion. Ford Pro continues to do extremely well. Almost all of the company's EBIT came from that segment. And 2024 EBIT adjusted expected to be $10 to $12 billion. So that's a big number for a company with a market cap of $44.5 billion as I'm recording. But you start digging into some of the numbers, and there are some concerns that really start to come out. If you look at this top section, this is the gap section. Some of these numbers are down slightly, but maybe nothing to be too alarmed by. We were at a pretty high point from a margin perspective in the auto industry a year ago. So makes sense that things are getting a little bit more competitive. Some of these margins, operating cash flow, things like that are going to start to come down. But when you get to non-GAAP numbers, and this is where management tries to pull out some of those one-time expenses, this is where things get much more alarming. In particular, look at this company adjusted EBIT margin, 8.3% a year ago, 6.1% in the first half of 2024. If you go over to just the second quarter numbers, down to 5.8%. So these numbers are all trending in the wrong direction. So that's where you should have some red flags kind of going off in your head. What in the world is going wrong at Ford? And if you go down to their segments, Ford Blue, kind of the traditional Ford Pro is going to be for contractors specifically. So mostly trucks are going to be sold through that segment. And then Ford Model E, this is their electric vehicles. So 26,000 electric vehicles sold in the quarter, down 23% from a year ago. That's not the trend that you would like to see for a business that should be growing. Revenue, $1.1 billion, down 37%. EBIT, negative $1.1 billion. This is always the one that people in the media attach themselves to. Lost over $1 billion in the quarter. That's absolutely true. But what's concerning about that is that it's heading in the wrong direction. It's actually $63 million worse than it was a year ago. So these numbers should be getting better. You would expect margins to improve. GM has said that they're going to be variable cost break even by the end of this year on their electric vehicle unit. Not sure exactly what that means because there's a lot of non-variable costs that go into building electric vehicles. Rivian has said that it's going to be gross margin positive, so similar metric to variable cost break even, but includes even more costs. But bottom line, almost everybody in the electric vehicle space is losing money on that business right now. The problem is Ford is throwing away basically everything that it makes in the core business, Ford Blue, by trying to get into electric vehicles. And that's, I think, really the challenge right now, is that they want to be an EV company. They're just not an EV company. Here's the other thing that got a lot of attention on the conference call was warranty reserves. So this was something that affected profitability for Ford in the current quarter. And what management says here is there are efforts to lift the quality of new products, and those are starting to pay off with positive implications for customer satisfaction and Ford's operating performance in the future. But the bottom line is, over the last few years, there's been some quality issues at Ford, and that ends up on the income statement in quarters like this when they have to take some of these charges, when they have to increase the warranty reserves that they have for current vehicles. Management did say a little bit later on here that if some of these quality improvements that they've been implementing take shape over the next few years, that will help the bottom line in the future. But right now, this is a pressure, is that there's higher warranty reserves at Ford than there are at some of their competitors. That's one of the things that's really impacting their profitability. So you add all of this up, and things are just trending in the wrong direction. The core business is declining year over year. EBIT was down about 50%. Pro holding up extremely well, but that may not last forever. And obviously, the electric vehicle space is under pressure. So there are these small margins in the auto business, and it seems like Ford is missing the mark in some of its quality aspects, and that ends up showing in higher warranty costs. So that was the big concern, was EVs and warranties in the quarter. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what I wanted to look at in particular was what was Ford specific and what was industry trends overall, because those industry trends are going to make their way to all of the other manufacturers that we can look at as investors. And then there's going to be the things that are just specific to Ford. So the warranty cost issue is going to be a Ford specific problem. The electric vehicle sales numbers in particular are going to be, I think, more of a Ford specific problem. That is Ford making the wrong EVs for the market and just a product that people don't want to buy. The Mustang Mach-E, not really setting the world on fire because it's not a design or a price point that people are gravitating towards right now. The other one that I think is interesting is the F-150 Lightning is not exactly setting the world on fire. Now, we've seen some of this, some weakness at Rivian. They're actually selling more R1Ss than they are R1Ts. So that maybe tells you that people who are buying trucks don't necessarily want an electric vehicle. We also know that GM is coming out with an electric Silverado. So that space is getting much more crowded. Demand not really there for the supply that's available, and those vehicles are also very, very expensive. So that tells you that there's both a specific problem with Ford, they're making the wrong vehicles for the market, but also there's weakness in certain segments of the market. That's maybe one of the reasons why GM has pulled back on some of their expectations for electric vehicles. Wait, if people aren't actually going to buy electric trucks, why in the world would we make them? Why don't we just keep making ICE vehicles where we're just printing money? That's where GM is trending. They have really gone back to being a more ICE-focused company. Ford is trying to make this transition to electric vehicles, and it's losing money in the process. It's kind of throwing good money after bad, and I think that's the real challenge. So you have the warranty-specific problems, you have the design-specific problems that are Ford, that are based just on Ford, but overall, I think you see the market for trucks and SUVs being extremely strong, and the companies that are going to focus on that, the ICE trucks and SUVs, are going to do extremely well. That's one of the reasons that I remain bullish on GM, because they have focused on that cash flow machine. The other thing that came up on the conference call is that management is not being really aggressive buying back stock. Shares trade for about 5 times forward earnings. That's analyst estimates over the next year. That would be a great time to buy back stock if you have the cash and you think that you think your stock is undervalued. But Ford is not doing that. GM, on the other hand, buying back about 20% of its shares outstanding on an annualized basis. So they're being very aggressive with buybacks. That's going to, at least long-term, give a boost to the stock. Ford doesn't have the same catalyst. So kind of a strange position for Ford to be in. But overall, I think the ICE market in particular, much better than a lot of investors anticipate. And the EV market is getting worse. That is really the big thing that we can take away from Ford's numbers. I think over the next year, companies that are specifically focused on EVs are going to have a really, really hard time financially. Now, doesn't necessarily mean their stocks are going to follow that, but revenue and margins are going to be under pressure. But what do you think about Ford's results and the meaning for the auto industry? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.